Your salary might be the most dangerous financial asset you own, because the moment it stops, your entire financial structure can collapse. Most people believe their salary is an asset. Structurally, it behaves more like a liability. Today, we're going to examine the math behind that claim. And once you see the numbers, the way you think about income will change permanently. An asset is something that produces income without requiring continuous labor. Examples include rental property, equity ownership, dividends, royalties, businesses. Assets generate cash flow even when you stop working. Your salary does not. Your salary stops the moment your labor stops. It is not a productive asset. It is operating revenue. And operating revenue must constantly support your operating costs. When that revenue stops, the structure becomes exposed. Let's examine a simple structure. Income, $120,000 per year. After tax, approximately $90,000. Now assume total annual expenses of $85,000. That leaves $5,000 in margin. Now let's translate that into ratios. The fixed cost ratio is 94%. The margin ratio is 6%. Pause for a moment. Look at those numbers carefully. A structure operating at a 6% margin has almost no tolerance for disruption. 2 months of lost income would create a $15,000 shortfall. The annual margin was only $5,000. That means a short disruption can erase the entire structure. High income, low resilience. Financial independence is not determined by income size. It is determined by structural ratios. Consider 2 professionals. Professional A income, $120,000 expenses, $115,000. Margin, $5,000. Professional B income, $80,000. Expenses, $50,000. Margin, $30,000. Professional A earns more. Professional B is structurally stronger. This is because independence is driven by margin capacity, not income magnitude. In engineering, a structure can appear stable under normal conditions. But when stress arrives, weak supports reveal themselves immediately. Financial structures behave the same way. High income can hide weak financial foundations, but stress always exposes the truth, and stress eventually arrives. Now run a simple stress test. If your salary stopped tomorrow, how long could your current structure survive? Take your liquid savings. Divide by your monthly expenses. That number represents your structural runway. If the result is less than 3 months, fragile. 3 to 6 months, exposed. 6 to 12 months, stable. More than 12 months, strategic. Many high earners are surprised when they run this calculation because income increased, but resilience did not. Lifestyle expanded at the same pace. Margin disappeared. The real question is not how much income you earn. The real question is how efficiently income converts into retained capital. Consider a raise of $20,000. If expenses increase by $18,000, only $2,000 remains. Conversion efficiency, 10%. But if expenses increase by $5,000, then $15,000 remains. Conversion efficiency, 75%. This is the difference between cosmetic income growth and structural wealth creation. Income without conversion becomes lifestyle. Income with conversion becomes assets. Your salary should be treated as raw financial material. It must be converted into 3 things: liquidity, assets, reduced structural risk. If the entire salary is consumed by expenses, the structure never strengthens. This is why many high earners remain financially fragile. Their income is high, but their retained capital is low. Your salary is not security. It is a tool, a powerful one, but still a tool. If your financial structure requires an uninterrupted salary to survive, your salary behaves like a liability, because the moment it stops, the structure becomes exposed. But if your structure can survive income disruption, your salary becomes something different. It becomes capital. Capital that strengthens liquidity. Capital that builds assets. Capital that increases optionality. This is the difference between income and independence. Income creates comfort. Structure creates control. Independence is not determined by income. It is determined by structure. Audit your ratios, because structure determines survival. If you want financial advice, there are thousands of channels for that. But if you want to understand the architecture behind financial independence, subscribe. This channel is built on one core principle. Financial independence is engineered, not guessed, not hoped for. Engineered. In the next video, we audit the fixed cost ratio, the one metric that predicts financial stress long before it shows up in your bank account. This is the personal auditor.